Hello, welcome again to another edition of Nucleus Investment Insights. Today we are going to be having a look at concentration risks. I've seen a few things out recently. Been a couple of research papers, and so the main two ones I want to talk about was first of all the size of particular stocks. So the Magnificent Seven in particular is getting a bit of a bad rap for making up so much of the market. And then secondly, the rise of passive indexing and people who are following the market in that perspective. And I just want to sort of talk around some of the numbers because depending upon where you look, you get just wildly different numbers and what that means in terms of price discovery and other factors like that. So without sort of any further ado, I'll jump straight into it. I do want to note everything here today is general advice in nature. None of it is personal advice. If you do want personal advice, follow the show notes, and you can have a chat with somebody from our team to talk that through with you. So so let's sort of jump into some of these thoughts. The investment. I'll start with some stats that sort of, I think, very much put into perspective the size of the market, because I think what can happen is people can get too caught up on terms of working out, how broad of a portfolio do you need to be sort of diversified, invested, and there's tens of thousands of stocks out there. Well, might be 10,000 globally that you can invest in, but the idea is how much do you need in order to become a significant part. And so the MSCI is largely a global organization. So most international investors tend to invest in MSCI type indexes, and then locally they'll invest in their own index. So, for example, if you took Australia, for example, most of the local investors who are investing in the ASX are probably benchmarked to something like the ASX 200 or the ASX 100 or the ASX 50, something like that. Most probably the 200, international investors into Australia will be benchmarked to the MSCI indexes. And so if you look at the sort of the weight of money out there as to how much is coming from different parts. And a similar thing in the US, the S&P 500 is a big one for US investors, but international investors, often it's some of the MSCI indexes. So what they do at MSCI is they do this thing called a free float adjusted market capitalization. And what do we mean by that in terms of free float? And I know this is getting a little bit deep in the weeds, but it's sort of it's slightly necessary in terms of understanding, just the picture behind passive indexing and how it works. Is that it's the size of the company minus investors that are considered to be long-term investors and aren't looking to sell their shares. So, for example, if you're investing in Fox or one of the News Corp ones, Rupert Murdoch they're going to take his shares out because he's considered this. Well, he's not out there buying and selling his shares, and so he's not really. We're actually only interested in the amount of stock that is available to be bought in terms of that. And so when they do those adjustments, and you say they've got sort of two different benchmarks they use. One is their sort of their large, medium, and large cap stocks, where what they're trying to do is cover 85% of the free float adjusted capitalization. And what does that mean? Well, in Australia, it means 60 stocks. Globally, it means 1,300 stocks. So there is certainly, from that perspective, there's concentration, but it's that idea that, look, there's actually not that many stocks that make up most of the market. So, because the large stocks are so large relative to the small stocks, you can just, in terms of Australia, if you're just interested in getting 85% of the stock market, you just need 60 stocks, and globally you just need 1,300 stocks. Then they have their 99% of the free float adjusted cap, and in Australia that's just 225 stocks. Globally, 5,000 stocks. So again, it's a pretty small sample set, and Australia has sort of. Actually, I must admit, I'm not quite sure the low number, but there's the ASX 500 is a bit of a benchmark that some people use as well, or the All Ordinaries. But there's 700 or 800 stocks. But the reality is most of that tail end of the stocks are so small, like some of them are sort of a couple of $1 million in market cap size, that one big stock, the movement of Commonwealth Bank from day to day, more than makes up for that whole long tail of stocks. So I guess that the message is, if you're investing in stocks, you don't need that many to get most of the size by market cap. Okay, so that's one thing. Next thing is this rise in terms of the passive investments. Just to go back to that one as well. That's true. It's slightly worse now than it used to be, say 5-10 years ago, but it's not dramatically worse. So the world maybe was 1,600 stocks 10 years ago, but it sort of ebbs and flows a little bit over time. And then if you said, okay, well, what about this rise in terms of passive funds? Now, a whole bunch of different ways you can calculate this. I've just got a study. I've got a chart up from a study that was basically going, if you just add up all the combined holdings of all the index funds, you get to 16%. But actually, you can pretty much double that in the US, because if you sort of take a view on some of the strategies that are passive but aren't actually that aren't actually in an index. So, for example, you might have a big fund, or the equivalent in Australia, a big super fund, that rather than buying an index, they might be running their own index in terms of doing the same calculations that they are, because these aren't complicated strategies that in terms of passive investment, and so you can basically and by looking at the trading patterns, you can see what's happening, and you can basically work out that it's probably about double that in the US. Now, that's just domestic ones. So then you say, okay, so what that was sort of a study tracking S&P 500 and the Russell, some of the Russell indexes and the NASDAQ, in terms of how much money is into these passive ones. Then you get the MSCI indexes that international investors are investing in as well. So some international investors will be the S&P 500, but a lot are going to be in some of these global indexes that are sort of run largely from MSCI, but also FTSE and a few other ones. And so you grab some of those calculations, and the suggestion there is that now passive strategies, if you sort of add those all up, passive strategies now have probably overtaken active strategies in terms of what the size of that market is. So, and this is where the fear comes from, in terms of people is saying, okay, so now we've got passive, which is effectively you just buy whatever's in the index, and if that's bigger than the people that are out there actively investing, now you've got this problem that prices are going to be driven up by people who don't care about the price. They're just throwing money into the index regardless of whatever's in there. And that's the fear, is you lose this idea of price discovery, where there's enough investors who actually care about price, that when the price goes up for a particular stock, say CBA, they decide, no, actually that's too expensive, I'm going to flip out and I'm going to invest into another sector. So, okay, so I'm still getting around to still stating the problems. I'll get to some of my thoughts in terms of the answers of these, and whether that some of these are valid in a minute. The other issue we've got going on at the same time, which is a sort of related issue in a way, is this idea that you've got some significant concentration in the different markets around the world. So, say the S&P 500, that's where most of the sort of fear, I guess, is coming about. So the top 10 stocks in S&P 500 are now about 50% of the index. Go back 10 years, and that was closer to 20% of the index. So the question is, how much of this index is really just driven on these couple of names at the top of that index that's really going to drive the market. And to sort of put this in context, this is pretty similar to the Australian index. So the Australian index has been like this for a long time. Lots of concentration risk within the Australian index. There's also you've also got a number of other. The US is actually probably one of the better indexes in terms of distribution. Like, there's plenty of other markets that are sort of worse than the US market in terms of this. If you say looked at, sorry, just trying to find my. If you say looked at a market like Denmark, that's been where what we've seen is the markets there. Sorry, just trying to get my pictures right. The markets in Denmark, more than 50% of the index was one stock a few months ago. So Novo Nordisk, the maker of Ozempic, And so what you really saw within Denmark was all the active managers, depending on what index you want to measure them against, but all the active managers are underperforming, because the issue was they are usually limited to what they can invest in. So most of them had these limits where they could only invest up to sort of 20% in any one stock. And so their index that they're trying to beat, 50% of it's made up of one stock, and they're only allowed to have 20%. Even if they loved Novo Nordisk, that's all they could have. And so they underperformed all the way up. And then the other problem is, then now they've been outperforming as Novo Nordisk has been falling. And so it's that question about, well, are we, is that genuinely what you're trying to measure out there? What actually does make up a market? Does it make sense that if you're in Denmark and you're trying to get sort of a stock market exposure, and in particular a domestic stock market exposure, does it make sense to have 50% of your money invested in one stock, or is that a sort of global stock that just happens to be invested in Denmark? And Australian investors have this problem going on all the time with, in particular, resources sectors, where they're global stocks, and they're a couple of percent, 1 or 2% of the global market, but they might be 15, 20, sometimes even 30% of the Australian market, depending upon where we are in the cycle. And so the question is, are we trying to beat those stocks, or are we trying to beat, say, a more Australian-based index? And so what's the what are the risks and returns around that? And the other one then is another sort of interesting index on that perspective is a similar one on Australian small caps, and that tends to be effectively a bet on, do you like small resource companies or not? So most of the fund managers who are small cap managers don't tend to invest in small resources stocks, and so when you have mainly because those stocks tend to be very high risk, and it's very much a call on whatever the commodity price is doing. And so what you see is small cap Australian fund managers tend to buy stocks where, I've been out and seen the company, I understand what they do, they're whatever, they own shops, or they own a factory, or they own whatever it is, and something where they can see recurring revenues. They're the types of stocks they generally tend to buy. And so when small cap resources booms, these guys all underperform. When small cap resources busts, they all outperform. And so there's this question about, what are we really trying to get to there? And so, and where are those risks? Some of the other factors. So we've got this picture of what's going on, and the question now is, how can you get around some of that issues? And one of the ways people try to get around both this concentration risk and this rise of passive investing is saying, well, maybe what we should do is equal weight. So rather than trying to say, invest in stocks based on the size of the stock, how big it is in the index, what we're going to do is just invest an equal weight in let's say, investing in the ASX 200, you just can invest the same amount of money in all. And so it sort of sounds like at face value a reasonable assumption. I think that the main thing for me is, when you do this strategy, you're explicitly taking a size bet. What you're effectively saying is small cap stocks are going to outperform large cap stocks. And that's where I guess I have the issue, is it might not be, that might be the right thing to do at certain stages of the business cycle, but it's not sort of a magic panacea that's suddenly going to solve a lot of these problems for you. So if you look at the long term, say back in the some of the longer studies, sort of back in the 1950s, there was a study that ran from 1958 to 2015, where based in the US, where equal weight was beating market weight by about 2% per annum. So significant outperformance over that time frame. Then if you look at some of the ones that extend into more recent times, there's one from another study from 1989 to 2023, where equal weight was beating market weight by about 1% per annum. And then since 2023, it's reversed, and you've had all that's disappeared in the space of 2 years. So market weight's beaten equal weight by about 35, 40% over that time frame. So it's very much this idea that you're taking a factor bet on it. and sort of you need to be comfortable that really is what what you want to do in terms of when you're making that decision to say, no, I'm worried about the rise of passive investing. I'm worried about the rise of I'm worried about the concentration risk within passive investing into these couple of stocks. Is that you're effectively taking a bet against those stocks. So which sort of goes against, in a way, what passive investing is meant to be. So if you're sort of, a lot of people take on the passive investing of saying, look, nobody can beat the market over the long term, and certainly over the last 20 years, there's been so much more focus on outperforming, and so you can't beat the market. You should just go passive. But then as soon as you make the decision, okay, I've gone passive, but actually I don't like the fact that I'm invested only in 7 stocks, or largely in 7 stocks, and so therefore I'm going to go to an equal weight. You've effectively stopped being passive, and you've started making this bet on saying, oh, you're betting that small caps are going to beat large caps over that time frame. And so, and I think there's certainly in this sort of passive versus active debate, you see lots of stuff out there, that is, look, passive managers outperform active managers over all these different timeframes. And I guess for me, when I look through these, the thing for me is the big question is usually fees within these. So, and you got to think about the whole market as being this, if everyone can't beat the average, and everyone can't be worse than the average, because what some of these studies sort of basically come out and say, oh, look, active managers are terrible, they all underperform the index, and passive managers are the best because they give you the average return, and retail investors, they underperform the index as well. And you're like, well, just a minute, you've given me 2 big chunks, retail investors and active managers, who are all underperforming. Index performers, which are by definition giving you the average, are actually slightly less than the average because there's fees on that. Who's on the other side of it? Like, how can you have everyone below average or below average? And that's where I sort of come back and go, well, look, I think for me, the true story behind this is that, look, active investors do tend to outperform on the upside, but a lot of them take all that outperformance back in fees. And so it's really a question about saying, if you're into a fund that's doing lots of active trading and outperforming the market, say by 2% on average, but then it's charging you 2 and 20, and there's all these extra capital gains costs of doing all this trading, is that, well, yeah, you've beaten the market, but the manager's taken all that back in fees. And so so there's that part. Secondly, then you have this overall thing in terms of passive, is that active managers tend to be underweight the larger stocks, and the traders tend to be overweight some of these larger stocks. And so when you go through a period like we have over the last sort of 10 years, where the large cap stocks are outperforming, what you tend to see is the passive funds are outperforming the active funds. And vice versa, when you go through the opposite the opposite case, is that you get the active outperforming the passive. And because we've been in this rising market, and seeing these large cap stocks outperform year after year, that's sort of been a large driver of what we've seen in terms of passive funds sort of outperforming over this medium term. And also, just to be clear as well, I've got, in terms of personal position, is that we run both active and passive funds. So we're trying to be everyone's got their own biases around this. I'd like to think we're relatively unbiased in terms of saying, look, we have both. We're sort of relatively ambivalent in terms of investors. If you want to go with our active and go for the lower volatility and what we think are better risk-adjusted returns, great. If you just want to go with the passive, the same, jump into that, and both of them, we'll sort of let you add stocks in and take stocks out. So hopefully we're relatively unbiased in terms of this, in terms of where we sit. Okay, so the theory then goes, or I guess the big complaints about this rise of passive investing come back to that what we're getting is disproportionate rises in the prices of large firms. So Nvidia goes up in value, therefore more passive investors buy it, therefore the stock goes up further, and it sort of just keeps on spiraling up. And You can find various research papers that sort of try to quantify these and either agree or disagree with that, depending upon what the outcome is. And I think that the key for me is, though, that it sort of matters in terms of what you're trying to do. There's this one, and also are we measuring what we really think we're measuring? Because I think in a lot of case that's not the case. So for example, there are a lot of small cap funds out there and a lot of small cap index funds out there, and these broad market indexes you can buy. So to take the Australian index, for example, we spoke about how the top 225 stocks gives you the free float market cap gives you 99% of the Australian index. Okay, so if you want to look at the Australian index, a lot of fund managers are by the ASX 200, but then there's this index called the small cap index, and that's basically every stock between the ASX 100 and the ASX 300. So it's a broad, it's got 200 stocks in it as well. They're all the smaller stocks. You can explicitly buy that, and now you don't have that big weighting. Similarly, in the US, the Russell 2000 index is very similar. So you got the top 1,000 stocks in the US. And then the Russell 2000 is everything from the 1,000 stock to the 3,000 stock, which again is, makes up 99% of the US market cap. I think even more than that. And so, is this just an asset allocation thing? So, if I stick whatever it is, 80% of my money into the ASX 200 index and 20% into the small cap index, then I'm actually overweight small caps now, and theoretically that problem's disappeared of just investing in large cap stocks and pushing them up. So some of this is a question about, well, is this just, are we just arguing semantics? Is that people are investing too much in the large cap indexes and not enough in the small cap indexes? And so that's why the prices are pushing up. Secondly is, I think there's also this slight misunderstanding about how this actually works in terms of an index investment, because index investments are incredibly low turnover, but for large cap index investments. Small caps, I'll deal with those separately. But what do I mean by that? So I go out and I buy, let's just say we're talking about an index of the 75 top stocks. So we bought our global index, and NVIDIA makes up 5% of that index. And so I put all my money in. I put $100,000 into it. I've got $5,000 invested in NVIDIA. NVIDIA doubles. Now it's not quite 10% of the index, but we'll call it 10% for the sake of it. So it's doubled in price. It was 5% of my index. Now it's 10% of my index. And so what's happened there is I haven't had to do anything. As an index investor, I don't have to go out and buy more NVIDIA. NVIDIA is just, because I owned it and it doubled, now it's double as a percentage of my portfolio. So there's not actually a mechanism where investors are actually out there chasing that. And if you're in an equal weighted index, you'd actually be selling NVIDIA right throughout that period. So NVIDIA, you only wanted 2% of that, and then it went up in price, and so you had to sell a bit and buy other stuff, and then depending upon how you went. So equal weighted indexes trade all the time. They're always sitting there going, I say I had 100 stocks in the index. I've got my $100,000. I only want $1,000 in NVIDIA. It goes up to 1,100. I've got to sell $100 and ship it out into other stocks, and then keep rinsing and repeating. So in a way that equal weighted strategy is like an anti-momentum strategy in a way, because you're always taking away from the stocks that are doing well and adding them into the stocks that aren't. And you're actually increasing capital gains issues in terms of that, because I'm selling the stock, I'm selling my winners and taking capital gains and then investing that in the losers and the ones without capital gains. Whereas in that passive index, the market cap weighted one I was speaking about, it's just, NVIDIA, as I said, it's doubled. I didn't have to do anything. And so there's no sort of fundamental push further into that. Where you do get a push further into is a couple of different places. One is when people are allocating new money. So yes, so somebody's gone, you've got your super funds going into that. Every month, $1,000 getting invested. Okay, last month it was buying 5% of NVIDIA. So I stuck $1,000 in, 5% of that money into NVIDIA. This month, now 10% of it's going to NVIDIA. But, NVIDIA is 10% of the market. So there's not, is that pushing up NVIDIA any further? Well, the proportion on buying of Nvidia is still the same amount. So yeah, there's maybe an argument about free float and a whole bunch of other things, but yeah, there is that. There's a I don't think fundamentally you can argue that there's a that as a whole it's making a big difference. At the margin, there is a sort of marginal question about it. The other thing is, as stocks come in and come out of the index, that makes a big difference. So stocks going into the 500, you get this great performance, and then stocks dropping out of that, the S&P 500 or the ASX 200 or whatever it is. There's definitely this sort of lift up and fall away. The issue for if you're trying to track that is most of that, or almost all of it, comes before the announcement. So people are tracking. There's plenty of funds out there, and hedge funds in particular, tracking these, and so it's basically just a mathematical argument about, okay, this stock's now this big, therefore it's going to go into the index, and therefore it's going to jump another 5 or 10% because it's going to go into the index, because all the passive guys then need to buy it. So that's the part where if you've got whatever it is, 20% of the index is people following the S&P 500. On the day that this new stock comes in, 20% of them people all of a sudden have to buy that index. And so stuff coming in and out of the index can be very sort of price sensitive and sort of throw that around. So that's that factor. The other one I wanted to talk about, just in terms of this large cap, small cap idea about, is a lot of this, just a bet on whether small caps are going to outperform large caps? Is that there's also and some of the equal, when you talk about some of the equal weighted indexes, there's two parts. There's another part to this, which is the especially some of those longer term studies. Let's bring up this slide. So I've just got a slide up showing the top chart's the average commissions charged, and this is in the US. And so it used to be up around sort of about 0.6, 0.7 in the 1950s. And now you're sort of, well, this went to 2000, it was down to like 0.1, and now we're down to fractions of that. It's now pretty close to zero. And so we've had this big decrease in the cost of trading. And then secondly is the spreads. So how much would it actually cost you just because there wasn't as much, anywhere near as much trading. So in the 1950s, the average spread was about 0.8. By this one, the average spread in 2000 was 0.2, and it drops even further again. And I guess what I would argue is that both of those were worse for small caps. So if you were paying a commission to get into a particularly small stock, you were paying a higher commission than what you pay to get into a large liquid stock. It is one. And then secondly, in the spread between the stocks, again, was much wider for small stocks. So this is the average. Let's say the average is 0.6. It's probably at the time was probably like 0.5 for large cap stocks, and it might have been 1 or 2% for some of the smaller stocks. And that's even for, common today, as we still see some of those. When you get into micro caps, you can still see that type of thing. But I guess the idea is, though, that as those came down, they actually came down a lot more as you had more and more trading. My contention is that they've actually come down a lot more for some of the small cap stocks. And so maybe that outperformance we've seen over that sort of, when you start looking at those longer term studies, is really just the fact that it was actually really hard to buy a small cap stock in 1950 or 1960. And as it became easier and easier and it cost you less, so if you were sort of giving up, say, 2 or 3% just in trading costs and spread and everything like that, back in the 1950s and 1960s, you needed to get 2 or 3% higher return. So you just wouldn't pay as much for small cap stocks. And then as those fees came down, now you might only be giving up, 0.2%. And so it's come down from 2% to 0.2. Well, that's a 2% change in the cost that's costing you to get in. So now that might have been, the lift in valuation we saw over that time frame, a chunk of that might have just been that. And then in large cap stocks, maybe it fell from 1% to get in to 0.1 or something like that. So you've got it in a relative sense. It's been much easier, and so that's sort of driven it. But the other thing is the valuation side. And so I'm going to ignore the pink line for at the moment on this one. So I've got a chart just up showing of the the three different sectors I sort of want to focus on is the mid cap ones, which is the blue line, the green line, which is the small cap valuations, and then the red line, which is the large cap. So back pre 2000, large caps were traded at a significant premium to the other two sectors. Then we went into sort of 2000, but that fell after the tech boom. And sort of we spent most of the 2000s with large caps actually priced underneath the value of some of these small and mid caps. And then what we've really seen since 2020 is actually probably even argue since the 2012, the gap's been closing and closing and closing. So a lot of this outperformance we've seen from large cap has been the change in valuation. And so there's two sort of parts to this as well. One part of this is, well, there's a sector specific part to this as well. So in the 2006 to 2008, a lot of the boom was in banks and financials. And financials just naturally have a lower price to earnings ratio than most of the other sectors. They're a riskier sector, and so that their value sort of never gets to excluding CBA at the moment, but traditionally the value never gets to anywhere near the levels you see of other companies. And so it's basically going, well, if 10% of my index is ordinarily financials, and then that grows to 30%, and that's sort of below average, then my overall average drops down. And then as the large stocks come in, if you look at stocks like Microsoft or Google, over a lot of that time period, they were actually priced a lot higher than that. They just weren't the biggest stocks in the market, and so they didn't have as much effect on the on that large cap index. And so there's this compositional thing about when I'm saying so I can clearly say that yes, valuations have lifted, and valuations are much higher than what they used to be for large cap stocks. But I can also say that actually valuations for some of the stocks within that group are actually lower than what they've been. Or Amazon's another good example. Amazon's actually a lot cheaper than it was for a lot of that period. It was trading at sort of 100 times PEs and things like that. And so the compositional change within that is important, and it is a matter of saying, well, if you are going to take a bet against these, then you need to be taking the bet against, you realize you're taking a bet against those specific stocks, the ones that have performed, which is an active performance. So yeah, and that sort of comes back a little bit to trying to work out, well, what are you really trying to get out of when you're saying I'm running this risk? Is the question of, well, what are you running the risk against? So is this the fact that you're trying to beat the market? And if so, what are you trying to beat? Which market are you trying to beat? Are you trying to beat an equal weighted index? Are you trying to beat the market cap weighted index? Are you worried about a global index? Are you worried about a country specific index? Or are you just trying to beat? You're just trying to get absolute outperformance. And so so I guess where I'm trying to come through from this is you can be very worried about the rise of passive investing and the concentration in it, but unless you're really sure about what you're trying to beat, then it can be a lot harder to try and work it out. It can be a lot harder to say, well, where's the fear? Because if all you're trying to do is beat what you see on the 500 or beat what you see on the ASX 200, then if you're going to try and switch and go to sort of equal weighted indexes or sales weighted indexes or something different like that, then you're actually physically taking a bet against passive investing. And so it's sort of, in a way, it's sort of, to me, it doesn't really make sense to say that I'm a passive investor and I'm investing in an equal weighted index, because to me that's actually saying, well, I'm agnostic as to which stocks I'm buying, but I think small caps are going to beat large caps, so I'll buy an equal weighted index. I think is how I would treat that type of investment. And then the concentration risk is sort of falls into this similar type of thing about, okay, so I'm worried about these top stocks. Well, if I want to beat the S&P 500, then I've got to acknowledge that they are 40% of the index. And so if I'm going to go underweight those stocks, and I've got to acknowledge that I'm taking a bet against the Magnificent Seven. And I think that whatever the AI or whatever that trend is, I think that's going to underperform the rest of the market. And so and so again, that's that if you're worried about that concentration, it's a question about why you're worried about it. And if you're worried about it from, I'm worried that these might be the stocks that might crash the market, and I don't want to be in those stocks, is a question about, well, okay, as long as you think the other stocks in the market are going to be better, because by sort of flipping out of those top 7 and into different ones, you basically say, okay, well, now I'm taking an active bet that whatever these other 493 stocks I'm buying are in the S&P 500, that Walmarts and Costco's and Unilevers and all these other sort of stocks within that are going to beat those top 7 that we're talking about. So the question, so okay, so that's sort of coming back to those. The last thing I just want to deal with is this idea about, okay, look, are we stuck in, as this passive investing rises, are we going to see more volatility, and are we going to see more, are we going to lose this idea of price discovery? Now, I do think there's an element at some point of losing price discovery, just in the sense of saying, if 99% of the stock is all held by passive investors who are just buying it for whatever reason, and only 1% of it's traded by other investors, then I do think it's hard for that 1% to influence the price enough to get that price discovery. So I do think there's an element there. But and this is all speculation as to where it is. If we're at 50% now, it effectively means we've got 50% of the market saying that are price sensitive, and 50% of them are just saying, no, I'm just piling it into the index. And then of that 50% that's piling it into the index, there's probably a certain element of at least who are doing a large cap, small cap. So when they're saying, okay, I'm putting 80% of my money into the S&P 500, and then I'm putting 15% into the mid cap 400, and the rest of it into the small cap money. Well, they're effectively taking that bet anyway. It's just they're doing it in 3 chunks, and so they're allocating up and down between them. And so when large caps getting too expensive, they are making a price difference by going into small caps. But then you have the rest of that, the other 50% who, when they are pushing stocks down, if they push them down far enough, they drop out of an index. Then you get extra price discovery. So I guess what I'm saying is there's a sort of some price discovery that comes from the active guys, and then when these things drop in and out of an index, that's when you get this sort of extra burst of price discovery from the passive guys. So there's that. So that's one part of it. There's and where's the border? Well, I don't know. I suspect it's at least for the large stocks. I think if you've got 25% of the stock that's outstanding, it's probably still going to be all right for a lot of the large stocks, and especially when you've got companies that are willing to go long and to go short. And in large stocks, it's feasible to go long and to go short these stocks to help sort of accelerate that price discovery when people think stocks are bad. In small cap stocks, maybe you do need a bigger margin, but well, not maybe. I think you do. And so in small cap stocks, maybe at 50%, it is starting to become a bit of a worry that the price discovery might not be as much. Insofar as fund managers there, they might be, because the funds are bigger and the stocks are smaller, they might be buying 5-10% of the stock, some of these active funds. And so just that chance for price discovery, you can be pushed around by simply what a couple of people think. But that's sort of been, I guess that's long been an issue in small cap stocks anyway. Some have a view that, look, market efficiency might actually be better insofar as, look, if you put a big chunk of the market, 50% of the market who's not doing anything, they're just holding onto those stocks regardless, is that actually that might just sort of lower the churn and lower trading costs and actually help active managers push things in the right direction insofar as, so if only 50% of the stock is trading, then, and I want to buy the stock because I think it's great, and there's me buying that stock is now making twice the effect that it used to, as if there was 100% of people out there buying and selling, because there's only 50% of the market I can buy from. And so maybe that means that the active ones that are left are having a much bigger influence on the price by what they're doing. And so that's sort of one other phase. it probably does mean more volatility within stocks, and it might not be linear volatility. But one part is that, as I said, big fund managers moving in and out are probably going to make more of a price difference to the stock. But then secondly, as stocks, they get worse, they get worse, they get worse. All of a sudden, they start dropping out of indexes, and as they start dropping out of indexes, that sort of begets more selling and more selling as it sort of goes on down the line. And that's sort of that interesting part that's for say for if I use the Australian stock market as an example, there's the small cap index, which is everything between the 100 and the 300. And it's a very different index that you get in terms of these. So in the large cap index, I spoke about saying you just don't have to do stuff. You buy your top 100 stocks. Say Commonwealth Bank goes up by 40%. Doesn't matter. I owned it, went up by 40%. I don't have to do anything. And then when a stock at the bottom falls out of the index, so the worst stock in there drops out the bottom of the index, and then I have to sell it. Well, it's one of the smallest stocks in my portfolio anyway. By the time it drops out of the index, it's probably 0.5%. So it's actually not making much of a difference to my overall portfolio, and the trading cost pretty low. And then I'm buying the best stock that's coming in from the small caps. That's just made its way into the index, and it's grown bigger, and then it comes into my index, and I'm buying maybe usually I might be buying 0.75% of that stock. So again, it's not a major sort of issue in terms of that funding sort of or the roll around. As a small cap manager, though, you're actually facing the opposite. So what happens is your best stocks, you buy your best stocks, and they're flying out the top of the index because they become too big for you, and you have to sell them. The biggest stocks coming into the index are the sort of, I'm avoiding falling knives coming out of the 100. So the stocks that have been underperforming and dropping, I'm always trying to work out, is this a turnaround? Is it not a turnaround? So the biggest stocks in my index are making that difference. And then at the other end, you've got the same effect at the bottom end, but again, that's not making much of a difference to your index, but it's the top end that's really changing. So when you do invest in small cap indexes, particularly somewhere like Australia where there's just not that many stocks within that, what you'll find is your allocation does change quite substantially over the time, and you probably trade a little bit, not probably, and you do trade a lot more than you would in, say, in a large index. Yeah, so that was those ones. The other thing just around the this idea of volatility is, you've got a lot of people out there, the sort of traders within the market, and it's the same argument for them in terms of saying they're the guys who are, stocks are going up, they're usually jumping in and buying it. Stocks are going down, they're taking the opposite position and shorting it or doing whatever. They're probably making a bigger difference now. So when there was 100% of the stock out there that was being bought and sold, there's a lot more scope for them to do whatever they're doing without influencing the market. Now, when they're doing those things, that is making a larger difference to it. And the last thing I just sort of highlight as well is there's sort of been this rise as well of these non-listed assets, in terms of particularly Australian super funds are into that market. Big rise in private equity, now with a lot of private debt going on out there as well. It's sort of this idea that, well, what we're seeing in terms of investment markets, is it everything? Like when, if the private equity market was sort of 5% of the overall market and 95% was listed, then when you're investing in listed stocks and you're looking at indexes like that, you're pretty confident you're seeing what you're seeing is a pretty broad reflection of what's happening in the investment universe. But now once that grows to 20, 30, maybe there's 30% of the money sort of sitting in these private companies, is that, and private debt and things like that, are you actually missing the full picture of what's going on? And then the flip story, though, for people who are buying into those ones, particularly now, is that there was a pretty reasonable argument 20, 30 years ago that, look, I can buy into these private assets and the valuations are so much lower because they're unlisted, and then they're not liquid. So there's this liquidity premium because once you've bought it, it's very hard to get out. And so if you're a super fund or somebody with this long time frame, then you can take advantage and go, well, if I can get a 2% better return because the valuations are lower, then it's worth doing. Now, because the prices have all been bid up and the prices are a lot closer to what you see in listed markets, the question is, are you still getting that premium or not in some of those? And as a bigger problem, the fees tend to be a lot larger in those unlisted assets. And so, I think in terms of unlisted assets, there's a lot of questions, and we'll deal with that in a future one about, are you still going to get the same returns you've been getting over the past whatever years? Anyway, hopefully that's assuaged some of your fears of passive investing, or at least given you sort of some ideas around that passive investing and concentration risk and whether you should be worried about it. Just a reminder, we're on every Thursday at 12:30. Got any questions, pop them in the chat. And if you've got any particular topics you want us to cover, make sure to put them in, and we'll cover off on those. We are going to be away next week, but back again in 2 weeks' time. Look forward to seeing everyone then. Thanks.